Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this week's show is titled Rinse and Repeat because of what we're seeing in terms of behaviour in investment markets, equity markets and bond markets. Now, the previous weeks, we've been talking about how the yields on the 10-year US Treasury and the 10-year UK gilt had been rising and the knock-on impact for equity markets. And initially, the equity markets were fairly sanguine about the whole affair. The yields were starting to pick up and that then started to spread globally and equity markets started to take note. We saw some weakness in equity markets starting to spread. Now, after last week's show, if you'd been keeping an eye on equity markets, you would have seen the nervousness pick up and equity markets started to weaken even further. So a good example is if you look over towards Asia at the back end of last week, we saw Asian stocks sell off 3 to 4%, and the Nikkei 225, so the Japanese stock market, fell as much as 4% in a single day at the back end of last week, and the Nasdaq fell about 3.5%. So equity markets were becoming increasingly nervous about this bond sell-off, and the weekend couldn't come soon enough. And the only place you could have really been and not be losing money was cash, because if you looked across the various different mixed sectors, so if you look at unit trusts, there are various mixed share sectors that have different allocations to equities. So they will have, for example, 40 to 85% exposure to equities. We have other sectors that have between 20 and 60% exposure to equities. What is interesting, if you compare the performance of those sectors in the back half of February, they've all fallen in parallel. What usually happens in the sell-off is that the portfolios with the biggest equity exposure tend to fall the most. It makes sense. If there's an equity market sell-off, portfolios that have the biggest exposure to equities will crash the fastest. What we've seen in the last 2 weeks is because the sell-off has been centered around bonds and it's leaked over into equities, bond markets and equity markets have been falling almost in tandem. So if you look at those different portfolios with varying bond and equity exposure, they're all pretty much falling in tandem. So your bond in your portfolio aren't providing the protection they usually do in this particular sell-off because the epicenter of the angst has been bond markets. And you can see the fear in markets had picked up by the end of last week. It hit the VIX, the market fear gauge had hit 28. And if you looked across to the VXN, which measures the same kind of fear, but in the tech-heavy Nasdaq, then that had pushed up towards about 36, which is a very high number, so much more stressed than what we saw in the normal VIX, which is a measure that relates to the S&P 500, which is a wider stock market index. So fear was creeping into the market, and the weekend came along and we got into this week, and it was a new month, and everybody was far more optimistic. Yields started calming down. Now, the central banks, such as the US Treasury, had started making noises towards the fact that they were watching what was going on in bond markets. And we even saw the Central Bank of Australia take action and start buying bonds to try and calm the jitters in their domestic bond market. But overall, at the start of this week, we started to see bond markets calm down a bit. Yields started falling, which means the prices of these bonds, the 10-year US Treasury note, for example, started to rise. That obviously enthused investors, and we saw equity markets rebound, especially the areas that had sold off the most in the previous week or so. So on Monday, for example, we saw the FTSE 100 rise by 1.6%. We saw the S&P 500 rise by 2.37% in a single day. And we saw strong moves in pretty much every equity market globally. But it was in the areas where we'd seen particular weakness, so in technology stocks and in individual technology stocks, that we saw the biggest rebound. So if you looked at Tesla, for example, on Monday, the share price rebounded over 6%. So there was a sense that perhaps this episode in bond markets, this wobble, was over. But as the week has progressed, we've started to see a repeat of what we'd seen in the previous week. So whether it's fears over different variants of the COVID vaccine that are coming about, so the Brazil variant that has now been found in the UK, whether it's fears over a potential bubble forming in technology stocks with very high valuations, or it's the fear of rising inflation, then we saw a repeat of the stock market wobble. But it was really all about bonds. The other factors, such as the COVID variants, are taking backstage. It's the bond markets that's once again causing stress for equity markets. So as I make this episode now, it's off the back of the Nasdaq 100 falling about 2.8% last night in America. And as I look at the screens now, we're awash with red. The FTSE 100 is down about 1%. We're seeing the German DAX down around about 0.5%. We saw Asian equities broadly fall overnight, so they're down around about 3%. So we are definitely in another risk-off sentiment, and the Nasdaq has actually broken down below its 50-day moving average. Now, moving averages are support lines that some technical investors look at. In very simple terms, it takes the average of the previous 50 days prices in the index and it provides a general sense of direction. And if a market breaks down below the 50-day moving average, for example, that shows there's been a definite change in short-term trend. And some people use that as a sign as there's going to be more weakness to come. It's a case of you choose your poison of what you want to really look at when it comes to technical analysis. But where does this all leave us? Because we're now back in a scenario where bond yields are rising. And last week, the 10-year US Treasury yield got to 1.5%. Now, that is a key level. When it broke up above that, that's what really spooked the market, because that was an old resistance line that suggests that if it's broken, there could be more upside to yields, perhaps going as high as 1.8% in the short to medium term. Well, that would mean that bonds would continue falling, and that could put more pressure on equity markets. Don't forget, though, that the real angst has come from the speed of rising yields rather than just the fact they're rising. The market is pricing in a more optimistic outlook for the economy, but it's the pace of the rising yields and the pace of inflation that they're concerned about that's causing this rapid repricing in bond markets and therefore equity markets, and particularly technology stocks. As I explained last week, they are sensitive to a rise in yields. But interestingly, we're seeing other assets. Gold is getting hammered at the moment because of the rise in real yields, and it's now falling towards the $1,700 level per ounce. That is a key level. If we break below that, there's a very good chance that the price of gold could unravel down towards maybe $1,500. But it's a line that you want to keep an eye on. It's been an historic line of support that markets tend to rebound from. Let's see what happens going forward. So overall, the market is in a position now that we're seeing some nuanced weakness, some broad weakness in markets, but there are some particular areas that are very stressed. Technology stocks is a prime example. And we're seeing a rotation into value stocks. Like I said last week, it's a pattern that was seen at the beginning of November when we had the vaccine trade. So there are days where the technology heavy Nasdaq is falling 2%, but the Dow Jones in America is actually positive. That is very unusual, but it's showing there's a rotation from these expensive growth stocks into stocks that are now seen as value plays in an economy that's opening up. And that in itself is a rotation, and rotations aren't the worst thing in the world for a stock market and even a bull market. So we have to put this pullback into context at the moment. If I run through some numbers, since the sell-offs in equity markets started mid-February, the FTSE 100, as I make this, is down at probably about 1.5%. Similar for European stocks. The Nikkei 225 is down around about 2.5%. That doesn't take into account last night's moves, but that will pull it down another couple of percent. If you go down, the S&P 500 is down about 2.8%. Emerging markets around about 4 to 5%. Similarly for Asian equities, and the Nasdaq 100 is down around about 8% since the weakness started in mid-February. So you can see this isn't a correction across equity markets. In fact, many markets are not a million miles from all-time highs or multi-year highs, but in particular areas there are stress. So technology stocks, for example, is the main one, and you're seeing that play out in funds within your portfolios. Now, the question becomes, will we see a bounce back, particularly in tech stocks? Normally, when they get down to this kind of level towards the 50-day moving averages, which they've broken through, then there's been a quick rebound in recent history, normally because the Fed has stepped in. So we've got to see what happens. But overall, on your portfolio, you're probably looking at values that are falling and wondering what's happening. Pretty much everything's falling. Even commodities are starting to show signs of weakness. And they have been one of the best performing asset classes year to date. And they still are up year to date, up around about 9% year to date, despite the fact gold's fallen about 8%. So the message for this week is we're seeing a repeat of what we've seen in the last couple of weeks. Bond yields are rising. It's causing a lot of stress. There's not much you can do to avoid losing money other than being in cash or avoiding the most pain in key assets like technology stocks. So over the next days and weeks ahead, keep an eye on the yields, particularly on the 10-year US Treasury, the 10-year gilt yield, bond yields more generally, and of course the VIX, the VIX, which is commonly called the Market Fear Index. See how that's going, whether that's pushing higher or not. And it'll be interesting to see what central banks say, what noises they make in the coming days and weeks, and whether this will therefore repair the market sentiment. But at the moment, markets haven't completely unwound. It just feels like the market is in a very bad place right now, with liquidity being poor. But at the moment, there's a feeling that markets are trying to work out which way things are going to go, whether we're going to rebound or head much lower. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Money to the Masses with a number 2 is the Twitter. Instagram, Facebook. Don't forget to join our Facebook community group, facebook.com/groups/money to the masses. And of course, don't forget to subscribe to our YouTube channel.